Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal Bank, ladies and gentlemen. I'm Hiral Dadia. We have with us Richard Harris, Chief Executive at Port Shelter Investment Management, joining in. Welcome to the show, Richard. It's a pleasure to speak to you once again.
Thank you,
My
Hiral.
first question coming to you right now is a couple of global events that everyone's looking out for is number one, with regards to where the US stimulus package goes. What happens with Brexit? Next in line is with regards to where the US elections are concerned. Now, with all of this, there is a major disconnect between what's happening in the markets versus what's happening in different economies. Still, we are scaling newer heights. How would you actually describe this entire phenomenon at the moment?
Well, I think it's very simple. I think it's all to do with liquidity. You know, if you increase the amount of money in the economy, you're just going to increase asset prices. And that's exactly what's happening. You know, the governments, especially in the West, have tended to say, well, let's blow out our budgets in
Mm,
order to support people who are going to be unemployed as a result of lockdowns, this kind of thing. Um, if you look at China, they've also done the same thing, but they've actually taken a slightly different view on it. They're making sure that people obey all the hygiene rules, but by the same token, basically there's no lockdown. So the economy's been able to get on. But either way, what we're seeing is a great increase in the supply of money.
mm.
And as we've seen so often, that money goes very quickly, even if it's given right to the grassroots, it goes very quickly into the people who control capital, and that goes to the stock market.
Mm. Right. So, is liquidity the only reason? So, if that's the situation right now, what's the kind of impact are we expecting in terms of US markets if you have to look at another stimulus package? Because earlier we did see a marginal disappointment that did come in when Trump said that I'm not going to release the next stimulus package till the elections are over. Now there is again some ray of hope coming in on that front. And secondly, elections where still the probability where Biden could be going higher, at least for the moment, goes higher.
Well, I think what the market's calculating too is that we're going to get something like $2 trillion worth of stimulus. Um, uh, you know, whatever happens. Basically, it's not going to happen before the election because why should the Democrats agree to anything with the Republicans before the election? You know, it's just a non-starter. Why give them any help? Now we've got 3 months or so,
Mm.
a little bit less before Trump, if he is defeated, has to hand over. So, of course, there's not going to be an awful lot happening in that time. But after that, if assuming the Democrats control both the House and the White House, I
Mm.
think we're probably going to see more than 2 trillion. So the bottom line is, if the Republicans get in, we're probably going to see 1.82. If the Democrats get in, we're probably going to see 2 trillion plus. So whichever way you look at it, that's an awful lot of money going into something like a 19 trillion
Mm.
dollar economy. That, as I said before, just goes into asset prices.
Right. And with this, how do you look at what's happening with the Brexit? It's a long, ongoing phenomenon that we've been witnessing.
Yeah, I mean, it's just a total shambles, really. Prime Minister Boris Johnson has really negotiated very poorly indeed. I think the Europeans feel they have the upper hand. They probably do have the upper hand because, you know, Britain's left now, and there's no real advantage to them to progress things. The most ridiculous thing is that many of the key sticking points that Europe and Britain have are really quite small. There are two in particular. One is about fisheries, which is a difficult one for Britain. The other is about state aid. Now, Britain has always been very much against state aid to ailing companies, but here they find themselves in a position where they want to have it. That seems to me to be a fairly small thing that that they will give in on. I think possibly the likelihood is still that some sort of deal will be done, but it'll be done very much to the disadvantage of Britain. So my views on the British economy and on the pound too are negative.
Right. And with all of this, what's the kind of ramification that you see uh, from short to medium term on the equity markets worldwide?
Well, I think what we're seeing, we've got an election coming up, but the election isn't necessarily between Biden and Trump. It's actually between liquidity and recession. The
Mm.
Western countries are already in recession. I don't think we need to look at it any other way. We're seeing some quite good recovery figures, but you would see that if the economy had crashed that much. So I think by the end of the year, we will see pretty well most Western economies having a year of recession. The markets aren't going to be too worried about that if there's still money flowing in, if there's still demand for investments. Interest rates are still very low, and in many places, the UK might even get lower. So I think that equities will be buoyed by that. So in the short to medium term, equities, I think, are probably the new gold. As we go further out, if we do see an onset of an elongated recession, maybe even depression, that obviously is going to be negative longer term. If we do see worries about inflation, because countries have been printing money, that's another issue as well. So I kind of think equities are going to be supported quite well in the short to medium term, but in the longer term, there's some very big problems building up.
Right. So, from a short to medium term perspective, it's equities that probably could be the new safe haven. However, what's the view that you see in terms of what happened with the dollar? Because it's seen a reasonable volatile year compared to what it has been. And taking that into consideration, there are a lot of moves that were happening with regards to gold.
Yeah, if you look at the dollar, first of all, I mean, you've got to remember that over the last 3 or 4 years, the dollar has been extremely strong against virtually every currency.
Mm.
So to have a little pullback, I don't think is necessarily a problem. And even now, we're very much in middling areas. So I don't really see there being much of an impact on the dollar, especially if we do have some negativity come through in the markets elsewhere. We have seen the Chinese renminbi do very well against the dollar. I think that's really rather an outlier. I think it may be policy led by China, but whatever happens, we still have a strong renminbi. We've seen some tick ups in the year in the euro and other currencies, but I don't see this as being a long term issue. And I think it would be extremely unlikely for the dollar not to be a safe haven. Gold has been interesting. Gold tends to move in very big jumps every 5 or 10 years or so. So it's a difficult investment really to pin your hopes on because it tends to appreciate over the space of 2 or 3 months and then just go still. Gold does have its issues. You can't eat gold. You can't get interest off gold. Indeed, gold actually costs you typically
Mm.
to hold. So it's a capital gain issue. I think a little bit of gold is interesting to have in your back pocket if the central banks continue to debase money. But primarily, I'd probably be keeping a reasonable weighting in equities, not massively high, but a reasonable weighting.
Right. So, between emerging markets, Richard, where would you place India right now?
Well, India, I think technically should actually look quite good to a foreign investor. It's likely to benefit from countries looking to move their supply chains out of China. Uh,
Mm.
many countries, of course, have significant supply chains in China, and they're just looking at moving a little bit out. That should help India. But I think so often India does disappoint in terms of its domestic rules and regulations. It's much harder to start a business. It's much harder to get established in India than even in China. China is still a very cheap place to produce, and it has a long history. India, of course, should be cheap too, but the on costs tend to be a bit of a blow. But all in all, I think India is in a pretty good position compared to many other emerging markets. It does have the ability to really furrow its own course, whereas a lot of smaller markets, smaller emerging markets, like the ASEAN markets,
Mm.
tend really more to be price takers and economy takers rather than leaders.
Right. So overall, what are the sectors which you think could be growth drivers, beneficiaries in terms of COVID?
Well, of course, the healthcare sector has been the big beneficiary of COVID. And it's interesting, in fact, that a number of the billionaires that have emerged from China in the last year have been COVID related, possibly due to vaccines, possibly due to healthcare, possibly due to equipment. All of that kind of thing is important. And I think that that will continue to bubble on. You know, we've seen a surge, and probably that first surge is going to come off now. But there is an enormous amount of research into therapies and also a lot of research into vaccines. India has quite a strong generic industry, and I think that will benefit too, because other drugs will be found to have therapeutic benefits as well that may be off patent, and that will play into the generic side. So healthcare obviously is very important. And then, of course, you have to look at technology, which has just blown out, of course, recently. And it's tough to invest there, especially as technology might be about to go through some turbulence with the Americans looking to accuse companies like Google and Amazon of antitrust methods. So that technology could be halted for a little bit, but I think healthcare still looks quite good.
Right. And overall, do you think I mean, markets right now, at least with India, we are expensive. In terms of valuations, where would US and Europe be?
Well, I think all markets are expensive at the moment. If you look at their historical ratings, they're way over what they should be. You would expect that with earnings coming back and markets continuing to move forwards. And I say once again that we're seeing a disconnect between valuations, between fundamentals, and liquidity. And what we're seeing really is a situation where, you know, people like me who learned their economics maybe 30, 40 years ago,
Mm.
most of those relationships we have to throw out of the window. Things like the Phillips curve, things like the impact of interest rates. You know, if interest rates are 0 or 0.5%, they have no real impact. In fact, interest rates have no real impact below about 2%. So one of the big issues that the central banks did was going for a zero interest rate policy really meant that they lost their power. So the central banks are largely out of the picture now. All they can do is really print money. The control of the economy, I think, is a lot looser now than it's ever been.
Right. So overall, do you see some scope of correction coming in with regards to markets taking the US elections into consideration, or even for that matter, Brexit into consideration?
Well, you know, I always say politics is short term, economics is long term. You know, it's a little bit like cricketers, which you would know well. You know, they say a form is temporary, class is permanent. And we do see a lot of moving around where politics is concerned. Sometimes there's a political change that will uh, very much impact economies, but
Mm.
usually it doesn't. I think we're going to probably sail through the US election. If we do see money coming into the market in the new year, the market will continue to recover. So all of that, I think, is quite positive for the markets on, say, a 6-month view.
Right, but and do you think if there is any negative trigger, maybe in the form of COVID, maybe in the form of, probably, I mean, a second wave coming in, uh, do you think we are still brittle, we are still fragile, where any negative news could collapse us?
I don't think so. I think we've really gone past that stage. You know, markets tend to move catastrophically on very new news. Now, the COVID news has been in the market for a long time. New news might be an extremely virulent strain that has a much higher mortality rate.
Mhm.
That would be new news. I think second, third, fourth phases are doing continued damage to the economy. Whether they will on themselves be sufficient news to tip the market of its current view, I doubt. We need to see much more virulent uh, outbreaks, or we need to see governments continue to extend their lockdowns. I kind of think looking into the future, that's going to become politically more and more difficult.
Absolutely. I think that's something which everyone's now watching out for. Thank you, Richard. Thank you so much for joining. And I know we're running short of time today, but we should see you back soon again
I
to
hope
discuss
so.
more from here on. Thank you so much and stay safe.
Thank you, Hiral. See you then. Bye-bye.
See you. Bye.